Welcome to the deep dive. So, you want to get up to speed quickly on the private equity secondary market. What's been happening? What's the outlook for 2025?
Exactly. And you've sent over a great stack of reports.
We have, and our mission today is to unpack all that for you, focusing on the key trends and what we might expect next year based on these industry insights.
Yeah, we've got Jefferies Global Secondary Market Review, Bain's PE Outlook, IOMAN Analytics Trend Report, some pieces from Moonfair on exits, Ropes and Gray's U.S. recap.
Vanguard's Outlook, William Blair Secondary Report. Quite a collection.
It really is. Good cross-section.
Okay, so just quickly for anyone needing a refresher, the secondary market we're talking about is basically where existing PE fund commitments get bought and sold.
Yep. Think of it like a resale market for those stakes.
Perfect. Okay, let's dive in. Looking back at 2024, it sounds like it was, well, a pretty massive year for this market.
Oh, absolutely. A landmark year, you could say. The Jefferies data puts global transaction volume at a record $162 billion.
$162 billion. Wow. How does that compare?
Well, it's a huge jump, 45% up from $112 billion in 2023. And it even beat the previous record from 2021, which was $132 billion.
Okay, so significant growth. Did it accelerate through the year?
It really did. The second half saw $94 billion in volume. That's 38% higher than the first half. Real momentum building there.
And was that across the board? Or driven by one particular type of deal?
No, it was broad-based, actually. Both LP volume, that's limited partners selling their stakes, and GP-led volume hit record highs.
Okay, what were those numbers?
LP volume was $87 billion, and GP-leds reached $75 billion, both records.
Right. So let's break that down. What was pushing LPs to sell so much? $87 billion is a lot.
Yeah, according to Jefferies, a few key things. Ongoing liquidity needs were definitely a factor. LPs needing cash, maybe rebalancing portfolios.
That makes sense, especially if distributions were maybe a bit slower than expected elsewhere.
Precisely. Also, the bid-ask spread, the gap between what buyers offer and sellers want, continued to narrow. That just makes it easier to get deals done.
Okay, easier price agreement.
Right. And there was just strong demand from buyers, especially for the bigger, more diversified portfolios. People wanted quality assets.
Interesting. And Jeffries mentioned something about new sellers.
Yeah, this is pretty striking. They found that 40% of LPs who sold in 2024 were actually doing it for the first time.
40%? That's huge. Suggests the market's really becoming more mainstream, maybe. A standard tool now.
I think that's fair to say. Less niche, more integrated into how LPs manage their PE exposure.
Okay, now what about the GP-led side? That $75 billion is also a record, and you mentioned a 68% jump in the second half. What fueled that?
Two main things there, based on the Jefferies report. First, you had more traditional buyout firms getting into the GP-led space. They saw it as a viable strategy.
So not just specialists anymore.
Exactly. And second, there was simply more capital available, specifically targeting these GP-led deals, more money chasing those opportunities.
Right, the demand side grew significantly.
It really did. That combination pushed volumes up dramatically.
And I saw something about deal size, too, the really big deals.
Yes, another sign of market maturity. Deals over $1 billion really increased. Went from 34 in 2023 up to 51 in 2024.
Wow. And that was both LP deals and GP lids.
Both. LP deals over $1 billion went from 19 to 27, and there were 24 GP-led deals over that threshold, too.
So the market can clearly handle these large, complex transactions now.
Absolutely. And speaking of confidence, pricing improved, too. The average price for LP portfolios went up for the second year running.
Okay, where did it land?
Reached 89% of NAV net asset value. That's up 400 basis points, or 4% from 2023 levels.
That's a healthy improvement. What helped push prices up?
Well, Jefferies points to rising public markets providing a better backdrop, Also, a good supply of high-quality portfolios hitting the market.
So good assets available.
Right, and maybe some early signs of recovery in M&A and IPOs, hinting at better exit paths down the line. It all boosted buyer confidence.
Makes sense. And was there enough capital on the sidelines to absorb all this deal flow?
Oh, definitely. Dedicated secondary capital money specifically raised for these deals hit an all-time high, $288 billion.
$288 billion.
Up from what? Up from $255 billion the year before, driven by successful fundraising by the big secondary players, but also, interestingly, new money coming in from evergreen retail funds.
Ah, those 40 Act funds. So retail investors are indirectly playing a bigger role here.
It seems so. That's a growing source of capital, according to Jefferies.
Okay, so 2024, record volume, records on both LP and GP sides. More big deals, better pricing, tons of capital. A pretty bullish picture.
Yeah, that sums it up well.
So, moving beyond just the headline numbers, what were the sort of underlying themes or drivers shaping the market in 24 based on all these reports?
Well, that liquidity need we mentioned was definitely a constant thread. Vanguard, Ropes and Gray, Jefferies, they all point to LPs needing cash or wanting to rebalance, and GPs looking for ways to return capital.
Right, a fundamental driver.
And you really can't talk about 2024 without stressing the role of GP-led deals, especially continuation vehicles or CVs.
Ah, yes. CVs. Bain& Jeffries highlighted those. Remind us quickly what those are.
Sure, so instead of selling a company, the GP sets up a new fund, the CV moves the company into it, and gives existing LPs a choice. Either cash out now or roll their investment into the new vehicle. Often new investors come in too.
Got it. So the GP keeps managing a promising asset, and LPs get liquidity if they want it.
Exactly. And they became super popular. Jeffrey says about 84% of all that GP-led volume in 2024 was through CVs.
84%. That's dominant.
Yeah, and within CVs, single asset deals focused on just one company made up just over half, about 54%.
Okay. So GP's really leaning into this structure. What else stood out as a key trend?
The pricing improvement we touched on was definitely key. Buyer confidence came back. Jeffries noted higher pricing across most strategies.
Like what specifically?
Well, buyout deals averaged 94% of NAV. That's pretty strong. And venture capital pricing jumped quite a bit, up to 75% of NAV.
Well, interesting for venture, given some of the volatility there.
Yeah, perhaps reflecting more mature quality companies in those portfolios coming to the secondary market, or maybe a better IPO outlook for some.
And younger funds, how do they price?
Also very strong. Jeffrey said buyout funds 3 years old or less were pricing around 99% of NAV.
Wow, almost par value. High demand for those newer assets then.
Definitely seems that way.
And we mentioned new capital sources earlier. That feels like another important trend.
Absolutely. Those traditional buyout sponsors stepping into GP lids was significant. And the growth of the evergreen retail capital, those 40 Act funds Jeffries mentioned, adding demand across the board.
Right, broadening the buyer base.
Exactly. And we also saw more innovation in how deals got done. LPs using things like preferred equity, managed fund structures, SPV transfers, not just straight sale.
A little more creative with structuring.
Yeah, and Jeffries noted that single buyer solutions were really common for LP deals, making up 63% of them, maybe linked to those more tailored structures.
Okay. Now, how does all this secondary activity fit with the wider PE exit picture? Did overall exits pick up in 2024?
Some sources, like Bain and Vanguard, did indicate a bit of an uptick in overall PE exits last year. But Ropes and Gray and Moonfair stressed that traditional exits like IPOs or strategic sales still face challenges. So the secondary market remains absolutely vital for liquidity.
So maybe exits ticked up slightly, but not enough to clear the backlog.
That's the sense you get. Bain had the striking stat. PE funds are holding almost double the assets they held back in 2019.
Okay.
But the actual value of exits is still roughly at that same 2019 level.
Wow. So a huge amount of value still locked up. You can see why secondaries are so important.
Exactly. It underlines the need for that alternative liquidity route.
What about fundraising for PE generally? Did that impact things? I know Bain and Ropes and Gray mentioned a tougher environment overall.
Yeah, overall, PE fundraising did dip in 2024, but interestingly, dedicated secondary funds didn't seem to suffer as much.
So capital still flowed readily into secondary strategies.
It seems so, according to Jeffries and Bain, which makes sense given the opportunities there. Although Ion Analytics did find European GPs expect fundraising to stay tough in 2025, so that's a potential broader headwind.
Okay. And regionally, any shifts in where the deals were happening?
Not really major shifts. Jeffries showed Western funds still dominate LP secondaries 95% of volume.
Mostly North America within that.
Yep, 80% North America, 15% Europe. Asia remained pretty small, around 4%.
Okay. And Ropes and Gray noted the U.S. PE market had a bit of a slower start to this year, 2025.
Yeah, early days, but something to watch maybe for regional dynamics this year.
Right. Okay, so that brings us to the outlook. After such a massive 2024, what are the expectations for 2025? More growth.
That's the consensus view, yeah. Jeffries, Ropes and Gray, William Blair, Vanguard, they're all anticipating continued growth.
Any specific volume forecast?
William Blair put a number out there. They're thinking around $175 billion globally for 2025.
So potentially another record year then. What's driving that optimism?
Pretty much the same factors continuing. Strong expected supply, both from LPs and GP-led deals. Lots of buyer demand. And crucially, buyers are well capitalized and ready to deploy.
And are they expecting the market to keep maturing, using secondaries more strategically?
Yes. Jefferies expects that programmatic use integrating secondaries into regular strategy will continue for both LPs and GPs. It's becoming standard practice.
Right, not just one-off fixes.
Exactly. And they also see strong fundraising for secondary funds continuing, plus those new capital sources like the evergreen funds helping fuel stable growth.
How much new capital are they expecting?
Jefferies estimates an $105 billion could be raised for secondary strategies in the next 12 months. And they think $24 billion of that could come just from the evergreen funds.
Wow, $24 billion from retail-focused funds is significant.
It really shows that channel opening up.
And the split between LP deals and GP leads. Will GP leads take over?
The forecast, particularly from Jefferies, is actually for a pretty even split to continue. Both sides are expected to keep growing strongly, according to Ropes and Gray and Vanguard, too.
Okay, so both remaining very active.
Yeah. And Jefferies also thinks we'll see even more of those billion-dollar-plus deals, maybe even some exceeding $3 billion.
$3 billion secondary deals. The scale is just incredible now.
It really is. Shows how central this market has become.
And the broader economic picture, does that support continued growth?
Well, the hope is for a reasonably positive macro outlook, which Jefferies thinks will help. And Vanguard stresses that a continued rebound in the overall PE exit market is important for the whole cycle, including secondaries.
Right, it's all interconnected. So for investors looking at this space in 2025, what's the takeaway?
Vanguard puts it nicely. They suggest it's an attractive opportunity for skilled investors with capital to find high-quality assets, potentially at good prices, a different way to access PE.
But not without risks, I assume. What are the potential headwinds or things to watch out for?
Definitely. Broader economic uncertainty is always there. Bain, IO Analytics mentioned that. Geopolitics, too. Ropes and Gray even flagged potential disruption from things like tariffs.
Okay, macro risks. What else?
Valuation. Even though pricing improved, Jefferies and Vanguard both caution that careful valuation is still crucial. There's always valuation risk.
Don't overpay.
Right. And that fundraising challenge for some PE firms we mentioned earlier, that could still be a factor indirectly affecting the market.
Got it. So potential bumps in the road,
Yeah.
but the overall direction seems positive.
That seems to be the consensus from the reports, yes.
Okay, so let's try and wrap this up. Our deep dive shows 2024 was truly a breakout year for PE secondaries, record volumes driven by liquidity needs, the huge rise of GP-leds, better pricing, and plenty of capital.
Yeah, fueled by both necessity and innovation.
And the outlook for 2025 looks strong, right? Continued growth expected, more large deals, further maturation of the market, though you need to keep an eye on macro risks and valuations.
That's a good summary. For me, the real aha moment from digging into this is just how much the secondary market has evolved. It's gone from this sort of niche, maybe slightly distressed corner to being absolutely central.
Right.
The scale, the sophistication, especially with GP-leds like continuation vehicles, it's now a fundamental part of how PE operates, how LPs manage portfolios, and how GPs think about holding periods and value creation. It's really come of age.
That's a great point. It's a core strategic tool now. Hopefully this deep dive has given you, our listener, a solid handle on these trends and what makes this part of the private equity landscape so dynamic right now.
And that leaves us with a final thought for you to consider. Given this ongoing growth and innovation, especially in GP-leds and the new capital coming in, how might this changing secondary market landscape reshape the relationship between LPs and GPs even further in the coming years? What new strategies or maybe even tensions could emerge as this market gets even more embedded in the PE lifecycle?